Yes, good morning, all traders. Morning. Today is yet another beautiful day, second month of March. Now, I look on several things, particularly today I'll be looking at introduction to Forex. You know, lesson number one in Forex is introduction to Forex. Lesson number one in driving is introduction to driving. So, our lesson number one is introduction to Forex. One, I look on several issues. I love my highlighter to mark on several things. Then, first chapter I'll be looking at the candlestick anatomy. Candlestick anatomy, just as humans, candlesticks have different body sizes. When it comes to trading, it's important to check the bodies of candlesticks and understand the psychology behind each. So in trading, there are so many ways that you can interpret a chart. Basically, you can use candlesticks one, you can use bar charts, you can use the line chart, but what has been commonly been used in this market is the candlestick anatomy. Okay, then we look chapter number 2. We look at the candlestick patterns. Candlestick patterns is an integral part of technical analysis. We should underline that. And they emerge because human actions and reactions are patterned and constantly repeated. Something again to look at. In this section, we'll learn how to recognize the most important candlestick patterns, the psychology behind its formation, and what do they indicate when they form in the market. So those are basically the key points that we look at this chapter of candlestick patterns. Then number 3, we look at the market structure. In this section, we learn how to identify trading markets, ranging markets, choppy markets. You'll also learn how these markets move and how to trade them professionally. You'll also learn how to draw support and resistance and trend lines. That's as we go by learning through the course of Forex trading. Then you look at number 4, something we call time frames and top-down analysis. Multiple time frame analysis is very important for you as a price action trader. You know, when you use the trend lines, you are a price action trader because you basically trade what you see. That's what we call price action trading. Then in this section, we learn how to analyze the market using the top-down analysis approach. This is what I teach. So at the end of this lesson, you'll be able to know how to do top-down analysis, to apply top-down analysis in your analysis or even in your daily trading activities. Then we learn number 5, trading strategies and tactics. In this section, you'll be learn how to trade the market using the price action strategy. That's the basic things. Then let's look at types of candlesticks. Let's look at the type of candlesticks even before we look at anything else. Let's look at the type of, let's just look at some of the strategies that we have in the market that are best that have been commonly used by traders. One, you have the gaffing bar strategy, the inside bar strategy. Underline these two. These two I'll emphasize on them. Trading trades exam. I highly recommend you to master a bigger section before jumping to this section, because if you don't master the basics, you will not be able to use these strategies as effective as it would be. Okay. Then, key thing in trading is something you call money management. You learn how to create a money management and risk control plan that will allow you to protect your trading capital and become consistent, profitable. So you should note that trading is a very risky activity that involves a lot of risks that can make you even lose whatever you have. invested. Okay, so let's look at we won't look majorly at the issue of candlesticks because candlesticks have been around a lot along than anything similar in the Western world. Japanese were looking at charts as far back as the 17th century, where the earliest known charts in the US appeared in the late 19th century. So that's how candlestick came to be. So we can look. We are not interested in the history of candlesticks. Let's jump that chapter for now. Okay. Why candlesticks are important to your trading analysis? Candlesticks are important to your trading analysis because it's considered as a visual representation of what is going in the market. You can analyze that part. You can analyze that part. That candlesticks are very important to your trading analysis because it's considered as a visual representation of what is going on in the market. By looking at a candlestick, we can get valuable information about the open, high, low, the close of price, which will give us an idea about the price movement. Candlesticks are very flexible and they can be used alone or in combination with technical analysis tools such as the moving averages, momentum oscillators. They can be used also with methods such as the dot theory or the Elliott wave theory. That one I look at it particularly at a later date. I personally use candlesticks with support, resistance, trend lines, and other technical things that you will discover in the next chapters. Okay, so let's go to majorly the types of candlesticks that you will encounter in your daily trading activities that has been used and that has been there for quite a long time. So let's look at that even before we look at anything else. Now we are there. What is a candlestick? That's general knowledge. Candlesticks are formed using the open, high, low, close of the chosen time frame. Then in a candlestick, you have something we call a body, a shadow, or even the wick. You can call it a wick. This one is the wick that you can see. This one is the wick. To highlight it. This one is the wick or the upper shadow. Then you have the lower wick or the lower shadow. Then you have the real body. Then you have price opened high. If you see at this point, this is the high. The high is where the price opened. If it's on let's say it's on if we normally have majorly two types of candlesticks. Majorly, you have the bearish and the bullish. But in this case, we are looking majorly on what candlestick and what a candlestick looks like. That's how a candlestick looks like with lower and high. So if the close is above the open, if the close is above the open, this particular one, we can say that the candlestick is bullish, which means that the market is rising in this period of time. Bullish candlesticks are always displayed as white candlestick. That's in most cases, but you can even change in properties, you can change them to be green. The most trading platform use white color to refer to bullish candlesticks, but the color doesn't matter. You can use whatever color you want. That's what we have to note. Candlestick body sizes. We have the long versus short. Long bodies refer to strong buying or selling pressure. If there is a candlestick in which the close is above the open with a long body, this indicates that buyers are stronger and they are taking control of the market during that particular period of time. Okay. the end of this lesson, you should be able to gauge yourself and should be able even to trade on your own. So I'm still trading, guys. Don't worry if I pause. I'm looking at my charts because I'm a trader full time. I trade full time. That's what I do for the last 3 years plus. So long bodies refer to strong buying or selling pressure. If there is a candlestick in which the close is at the open with a long body, this indicates that buyers are stronger and they are taking control of the market within a particular period of time. Conversely, if there is a bearish candlestick in which the open is above the close with a long body, this means that the selling pressure controls the market during its chosen time frame. Short and small bodies indicate little buying or selling activity. Note that. Then you have the candlestick shadow or tails. That one I talked of it previously. I talked of wicks or tails. The upper and lower shadows gives us important information about the trading session. Upper shadows signify session high, lower shadows signify session low. Candlesticks with long shadows shows that trading action occurred well past the open and the close. Like this one. In later chapters, we look at what you call them. Doji is what Doji is the pin bars. We look at that. They are very important in trading. Whenever you see them on your charts. Japanese candlesticks with short shadows indicate the most of the trading action was confined near the open and close. If a candlestick has a longer upper shadow and short lower shadow, this means that buyers flex their muscles and bid price higher. So if a candlestick has a longer shadow and short lower shadow, this means that buyers flex their muscles and bid price higher. So it means that there's a lot of buying pressure. So it means that the bulls are in control. But for one reason or another, sellers came in and dropped price back down to end the session back near its open. Its open point is what we are talking of. The longer, yes, it has the longer upper shadow than the lower. It has a shorter lower shadow and a upper longer shadow, or a wick, or even a tail, a longer tail than the lower tail. That means that sellers are pressing on. Buyers were in control, but sellers came in and posed a lot of pressure. That's why price closed below where it opened at. Now, let's go chapter today. It's an introduction. So don't worry, look up to page, let's say page 30 or 20. We look at different things in our introduction. So we have to look at the introduction. So we have gone directly to the what we call types of candlesticks. And the first one we are going to look at the engulfing bar candlestick pattern. It's a very important topic to note, and it's a very important topic to every trader, either beginner or even a professional trader, that you should note wherever you are. The engulfing bar, as it states in its title, is formed when it fully engulfs the previous candle. The engulfing bar can engulf more than one previous candle, but to be considered an engulfing bar, at least one candle must fully be consumed. So you have to wait for at least one candlestick to be fully consumed. Then you can make a trade at the start of the second candlestick after the engulfing candlestick. That's something that you should note. Let's look at bullish engulfing. The bearish engulfing is one of the most important candlestick patterns. This pattern consists of two bodies. The first body is smaller than the second one. In other words, the second body engulfs the previous one completely, like illustrated here in my illustration here. This is an illustration of a bearish engulfing. You can see this one is a bearish candle. It means the price opened higher and closed low. That's for a bearish pattern. So as you can see in this particular case, the candlestick, this candlestick engulfed this one fully, meaning it is surpassed the size of the previous candle. That's why we call it an engulfing. This one, if we get a confirmation of a second candlestick, let's say a confirmation of a second candlestick, looking how I can draw. So if another candlestick forms, like in that particular, let's say in that, if this one was a continuous chart, so if another candlestick forms to confirm the bearish action, then as a trader, you can take a short or you can sell at that particular market price. This is how a bearish engulfing candle bar pattern looks like on your charts. This candlestick pattern gives us valuable information about bulls and bears in the market. Then I'll share this ebook to any person that will be interested in it, so that you can check on it. Now this one is on a bearish engulfing bar on a continuous chart. You can see these are illustrations that was just taken from Euro USD chart. So you can see the trend was continuous, like you can see. So you can see the trend was bullish. Then at that particular point, it may be resistance. There was a candlestick that was formed that looks like somehow bearish, or even it was like a doji. But then after that doji, what preceded, there was a bearish candlestick, the black one. Then this one could have given you an opportunity to make a short or sell at this particular point. Then your stop loss could be just above the bearish engulfing candle. Then you have the bullish engulfing bar pattern. You have the bullish engulfing pattern, which consists of two candlesticks. The first one is a small body, and the second one is the engulfing candle, just like from the previous chapter that you have just tackled. You have the smaller body. This now is on a trending bearish market. That's why you look at the bullish engulfing. You have the smaller body, then a fully engulfed bullish candle to confirm a bullish trend. The bullish engulfing bar pattern tells us that the market is no longer under control of sellers, and buyers will take control of the market. When bullish engulfing candle forms in the context found for an uptrend, it indicates a continuation signal. When a bullish engulfing candle forms at the end of the downtrend, the reversal is much powerful. It's represented below. We have an illustration here. Like you can see, this one was a bearish. It was a bearish pattern. all trending in a bearish way. Sellers were in control from this point to this particular point. Then it's at the support zone that we had a bearish, we had a bullish engulfing candle that preceded the previous bearish candlestick. That's how you can say it's a confirmed bullish engulfing bar. Then it was preceded again by another bullish bar to confirm a buy. So you could have taken a buy from this particular point and your stop loss could be just below the engulfing candlestick. Then we have the Doji Candlestick. Doji is one of the most important Japanese candlestick pattern. When this candlestick forms, it tells us that the market opens and closes at the same price, which means that there is equality and a decision between buyers and sellers. There is no one in control of the market. That's what a doji means. That's both buyers and sellers are at par. No one in control of the market at that particular instance or at that particular juncture. Like the illustration below. You see, higher price, closing price, and both the opening and the closing price are at par, which means both buyers and sellers, they are in a tussle or they are at war. No one is in control of the market. Now look at the doji. One thing that you should note is that a doji can show a continuation of a pattern or even a reversal pattern. Can show a continuation of the market structure or even a reversal in the market structure. That, like in this particular example of ours here, this particular doji posed a threat to the buyers who were previously in control, then giving a chance to the sellers who now came into control to control the market. That's how you can use a doji. But basically, very important doji are those doji candlesticks that are normally found on a support or even a resistance zone. So you normally check on dojis at either the resistance or the support zone at any particular point. The chart above shows how the market changed direction after the formation of the Doji candlestick. That's what I've just explained. The market was trading up. That means that the buyers were in control of the market. Then the formation of the Doji indicates that buyers are unable to keep price higher and the sellers push price back to the opening price. This is a clear indication that a trend reversal is likely to happen. Remember always that the doji indicates equality and indecision in the market. You'll often find it during periods of resting after big moves, higher or low. When it is found at the bottom or at the top of a trend, it's considered as a sign that prior the trend is losing its strength. That was just according to my explanation that I did above. So if you're already riding that trade, it's time to take profit. It can also be used as an entry signal if it's combined with other technical analysis. Then we have types of dojis. One, we have the Dragonfly doji pattern. Dragonfly doji pattern, it's a bullish candlestick which is formed when the open high and close are the same or about the same price. What characterizes the dragonfly is the long lower tail that shows the resistance of buyers and the attempt to push the market up. Okay, this is how the dragonfly looks like. It has a longer tail or a longer lower tail with no upper tail, or with just a short upper tail, or even a short upper wick in another language. The illustration above shows us a perfect dragonfly doji. The long lower tail suggests that the forces of supply and demand are nearing a balance, and the direction of the trend may be nearing a major turning point. Okay, you can see how the doji has been used to indicate a bullish reversal. In the chart, you can see sellers were in control. Then what happened after a dragonfly doji was formed? Buyers came into control because you can see there is a lot of pressure. Buyers are pressing high, they are pushing sellers. Then at this particular juncture, they won, and the trend reversed from bearish to bullish. So this one can confirm an entry when it's at the support zone. You can do support zone. You can do trend lines to know if this particular one is a support zone. Majorly, support zone is the majorly tested lower high zone as a support. In the chart above, the market was testing the previous support level that caused a strong rejection from this area. The formation of the dragonfly with a longer lower tail shows us that there is a high buying pressure in the area. Okay. Then we have the gravestone. Let me check my time. Check my time. We still have some time. We have the gravestone doji. This one is the bearish version of the dragonfly. That's what the gravestone, which means buyers are in control. Then sellers pose a lot of pressure at that particular point, giving room for sellers. The formation of a longer upper tail is an indication that the market is testing a powerful supply. Okay. Like you can see here, checking on gravestone doji. These are the gravestone doji looks like, and it's majorly formed at the resistance point. So it's the opposite of the dragonfly doji. You can see at this particular point is where we have the resistance point. Looking even at the structure of the market structure itself, you can see buyers were in control. Then what happened after that? We can call it even the inverse dragonfly. After the formation of the gravestone doji, sellers pressed. Sellers came into control, giving buyers a lot of pressure, and then buyers were forced to give up, then giving sellers the opportunity to control the market. Okay. Then you should know that as a trader, you will need additional information about the placement and the context of gravestone doji to interpret the signal effectively. This is what I will teach you in the next chapters. So keep on following. Don't tire. I'll be teaching chapter by chapter from this particular ebook, or from this particular book. I'll be teaching chapter per chapter. So it's your time now. What you'll be doing is just follow the channel, follow the YouTube channel, subscribe, then you'll be able to learn from time to time, because without having explicit knowledge in trading or explicit knowledge in forex trading, you cannot be a consistent profitable trader. You can be profitable today, but tomorrow you're not profitable. That's now what you call you apply guessing without proper learning. Then you have the morning star candlestick. Morning star is majorly formed after formation. You can confirm a morning star by having three candlesticks. Either we have the bearish, then something like a doji, either bullish or bearish candlestick that looks like a doji, then a bullish candlestick. This one will give you a confirmation for a buy signal if it's formed on a trading bearish pattern, which means you can check at the morning star basically on a bearish trending market, basically at the support zone. There's a bullish reversal pattern. It often occurs at the bottom of a downtrend, just like I've said. It consists of three candlesticks. The first candlestick is bearish, which indicates that sellers are still in charge of the market. Then the second candlestick is a small one, which implies sellers are in control, but they don't push the market much lower. The third candlestick is a bullish candlestick that gapped on the open and closed above the midpoint of the body. The morning star pattern shows us how buyers takes control of the market from sellers. When the pattern occurs at the bottom of the downtrend near a support level, it's interpreted as a powerful trade reversal signal, like you can see below here. If it's performed at the support zone or even on a bearish trending market, then we have the big bearish candle, then a doji, or even somehow let's say like a gravestone, or even a dragonfly doji, or even a normal doji forms in between, or even a small candlestick that is smaller as compared to the previous candlestick, then a confirmation candlestick to give you a bullish signal. This is where most sellers are trapped, because they still think that this one is a continuous bearish pattern. Then after the reversal, it may form another bearish candlestick, or even another bullish candlestick. This one is something we call the inside bar. In our later chapters, we look at the inside bar and how to apply inside bar. So for today, I'll reach at morning star. So tomorrow I'll continue from morning star to the next 3 or 5 chapters. Thank you all.